Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Just a reminder, next month kicks off our CEO Summer Series. We're going to be putting out an episode a week interviewing public market CEOs. We're going to kick it off with Kevin Strain. He's the CEO of Sun Life. Then we're going to have Ross Beatty, the chair of Equinox Gold. We're going to talk about gold prices, of course, and what it takes to get Equinox Gold off the mat. David Cassie, one of the most prolific investment bankers on Bay Street, gives us his view of the financing environment in Canada. Then we're going to speak with Bob Dylan, not the musician, but he does have a cult-like fan base, specifically because he has created this real estate juggernaut in Western Canada that has dominated other real estate stocks. Speaking of real estate, we've got Michael Cooper capping off that CEO series, and he'll give us his view of investing in Canada's real estate sector. And actually, that's exactly what this episode is about as well. We've got Michael Missaghie of Arch Corporation, and they're super interesting. They do private investments, but also public investments. And recently, you might know that they were an activist on InterRent, which ultimately got sold. We talk about why now is ripe for M&A, and he gives us many names that he thinks are takeout candidates in the REIT space. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. All right, In the Money listeners, you're constantly analyzing charts, spotting trends, and making calculated moves. That's where BMO InvestorLine comes in. Take your trading strategy to the next level with their advanced platform packed with real-time data, options analysis tools, and commission-free ETF trading. Start investing today at bmo.com/investorline. Michael Missaghie, thank you so much for joining me on the show.
Great to be here, Amber.
There is so much happening in real estate and the REIT space right now. We're in the thick of earnings season. Love is in the air. There's lots of M&A, and you've played a key role in some of that, which I promise we will get to. But I'm going to make the viewers hang on a little bit because I think it's just worth, a lot of people know you. You know, you're a prolific real estate investor, but just kind of like an introduction. What's your bent? What's your approach to real estate and your history in investing in this sector?
Yeah, thanks, Amber. I appreciate the question to start off with. Real estate has sort of been a passion of mine, but I did fall into it. My history in investing is I started as a 17-year-old who really just got into loving stocks, investing, asking my dad to borrow a little bit of money to invest, and probably losing that money when I initially invested it. But that passion stayed with me throughout my life. In about 2008 or so, I was finishing off my MBA, and I got an opportunity with Century Investments, and it happened to be an analyst on the REIT side. And for people that don't know too much about jobs and finance, getting onto the buy side right out of school is not that easy. So obviously, I was ecstatic about that. I went in and I gave my heart and soul to real estate, and that was, call it 17 years ago.
In 2008,
yeah.
Which, let's remind people, was a terrible time.
It was a terrible time. So I flew into learning right about real estate, how capital intensive it is. We went into the financial crisis, and that's when you really started to see, those opportunities that when I look back, I saw were huge opportunities, but in the moment, people were really afraid.
I mean, when we talk about crises in the real estate market, everybody's always looking for the next crisis because of 2008, right? I think it created this feeling of insecurity in real estate. And even though real estate since then has been a fine investment, better than fine, that has really left a lot of scars on people waiting for holes or, the cockroaches to crawl out of the real estate thesis. What did it teach you starting at that time?
Yeah, I think it taught me a number of different things. I think the most important is that you have to be greedy when others are fearful. There were multiple opportunities during that crisis, and it really framed the idea for the business that I started a few years ago, and we'll get into that. But from a financial crisis standpoint, what we saw was REITs were trading at a material discount to NAV. And we saw that during COVID as well. And we're seeing a little bit of that today. And what you're able to do is see that difference between what's happening in the private market and what the liquid public markets are giving you in terms of pricing. And that differential has always been one of the best opportunities to make money in real estate. And it's why we started the platform we did with Arch in 2018.
And frequent listeners of the podcast will know that we talk about this a lot with previous, real estate analysts. Right now, it seems it's cheaper to buy real estate in the stock market than it is in real life. But before we get into that, you mentioned going out and starting Arch. You're not just a public REIT investor. You do deals on the private side. What is the ethos? What's the platform?
Right. So again, finishing off that story from Century to today, in 2017, Century agreed to be sold to CI Financial. I had the entrepreneurial bug kicking in me already. There's a little bit of family entrepreneurial side as well. And what I wanted to do was be able to utilize the knowledge that I'd gotten at Century to be able to build out a platform that could look both at private and public real estate. And so what we did with my business partner at Arch, Dan Argyros, we built a platform that looks at both private and public real estate. So we invest across multiple asset classes on the private side through private equity vehicles, such as seniors housing, retail, some multi-res is in the group as well. And on the public side, we partnered with Anson, where we run our Arch Anson tactical fund there. And this really gives our investors the opportunity to know that we're one of the most unique platforms in Canada that looks through both lenses in real estate.
What's the split then? Is it 50-50 public-private? Does it switch based on where the opportunity is? What does it look like right now?
Well, it depends on how you look at that in terms of asset or equity value. You're going to be more tilted to the private side generally, but the opportunities ebb and flow. So when there are opportunities in the public markets, it's usually because it's difficult to raise money on the private equity side. When the public markets are very elevated and you're seeing huge premiums to NAV, it usually coincides with private equity really being out there, M&A being all over the place, and them being able to raise money very, very easily.
We use the terms NAV, net asset value, which is basically what, the market believes the value of the assets is being held if they were to be sold. Is that an easy way to kind of say it? And then if a stock is trading at a discount to it, they're not getting a fair shake for their NAV. And we talk about that, is there always kind of a historical discount, or does it ebb and flow? Sometimes these REITs can trade at a premium to what they could transact at.
Yeah, I think historically before 2021, if you looked at an average of where the REIT sector has been trading, it trades at a slight premium. But there are periods of time like 0809, COVID, and more recently with the interest rate increases, where you see net asset value discounts really become more prevalent. And there's usually reasons for it. 0809, COVID, we know. Now we're more in a situation where the macro uncertainty really around inflation and interest rates has driven this NAV discount.
What are you doing in the private markets right now in terms of opportunities and transactions that informs your view of the public markets? And I ask that because this is a sector that garners a lot of interest. For Canadians love their REITs. They love their dividend paying stocks, and we love real estate. We love talking about it, obsessing over it. And recently, REITs have started to perk up a little bit, and some of that is because of M&A. But I'm curious how you've got that lens into private. What does it tell you about what's going on in the public markets?
Well, our lens into private is so key for what we do on the public side. We're able to see exactly how much capital is being raised by our peers and by us. It tells us what institutional investors are saying to us when we go in and try to raise capital. It tells us what's going on in the acquisition and disposition market. And it also really informs what's going on in the debt market. So instead of going to a management team and saying, hey guys, what are you seeing on the acquisition side? What are you seeing on the debt side? We have our own information. So we're able to utilize that and really put together our own net asset values and understand exactly whether the market's turning and it's a good time to take a large position in a company and really engage the management team and the board, or maybe it's not going to be a good time.
So let's answer the question. Is the market turning and is it a good time?
We really do feel that you've seen some signs of inflection here for the REITs over the last, call it 6 to 9 months. You've seen macro stability step in, so inflation has dropped, though not to where the central bank wants it to be. It's really gotten to a point right now where we think that it's getting there. Rate rises have stopped and they started to decline in some other developed markets. You started to see M&A pick up. And there's a lot of dry powder from a private equity perspective, but they're waiting for valuations to clear and for the macro environment to stabilize. So all those things will help push REITs forward over the next 2 years in our view.
We're so close to the InterRent conversation, I promise. But first I want to ask about a story that's grabbing headlines right now, and that's the condos. And just that it seems like a basket case based on these headlines. But I look at bank stocks trading at record highs. You know, if there's lending risk, it's not showing up. So I want to know, like, why is there a disconnect between the headlines painting doomsday on the condo market, but then the way things are being priced in either private debt or in the public markets, maybe not reflecting that stress? Is it complacency, or are they accurately pricing in what's really going on in condos? Yeah,
I think it's tough to really point to a particular stock that's trading in the Toronto market and say that's a real reflection of the condo market. We've actually done a fair bit of work on the condo market on our private side of the business. We've looked at acquiring units, possibly providing debt, and it's very clear that there's distress going on there. But there are a number of players, including us, that are circling it to see whether there might be an opportunity there where you're going to help developers who are in trouble, or individual investors who want to get out of their unit or close their unit. And I would say, anecdotally, we even had a meeting in our office yesterday with a group that does consultancy on condos. There is a lot of trouble that's going on there, and there's more to come.
There's more to come. Like, how bad, how widespread?
Well, it all depends how much equity comes in to clear the problem, whether banks start, appraising units, for example, at what investors purchase them at rather than what they're actually valued at today. Is there any government intervention? There's a lot of things that could happen.
You think it should get to that point, that there would be a government intervention?
I think there's already people talking about it right now, right? It's one of those things that it's very, very likely that this is going to be a problem that's solved by the private equity market and private capital, the debt market, the banks, and possibly government intervention.
What kind of price declines, because the condo prices have already come off, what kind of price declines do you think could be in store?
I mean, we are seeing units right now that probably would have been trading when they were purchased at $1,200 to $1,400 a square foot that are going to be closer to $800 a square foot now.
And is it all because of immigration? Because I remember talking to developers and they said, we don't need immigration. We have a housing crisis. We don't need, how can we be a country with a housing crisis, but then also a struggling condo market?
Right. I think the condo market stands alone in terms of the overall housing market. And there's two particular markets. It's Toronto and Vancouver that are struggling. And it was driven by multiple factors that have sort of come off over the last few years. Investor market was driven by, in a large way, in immigration. You saw the foreign buyers tax come in that really put a halt to that. The interest rate rise also hurt as well. And the ability to, carry a condo with the rent that you would be charging started to disappear. And the developers out there, the land price and the cost of construction elevated to a point along at the same time with that macro rate rise. And that really was the combination. And so our view, though, is that while this is cleared, in the next, call it 28 and 29, you're probably going to see very little to no deliveries of condo units. There's a lot of tumbleweed going by condo sales centers right now.
So it sounds like you're waiting to be opportunistic, but we're not there yet.
I think now is the time to start looking at it. Absolutely. And that's why we're out there. We're speaking to our own investors. We're speaking to developers as well as other people that are involved in the condo market to see whether that opportunity really is attractive enough for us to get involved.
Let's talk about the opportunity that you saw on the public side with InterRent. This is the moment now. So InterRent plays in the residential multifamily space. And basically, Arch and Anson took a position and agitated for the sale of this company. And a buyer came through in the executive chair, combined with a Singaporean fund, which already has some presence here in Canada. And I think people looked at the premium or the offer on the table and thought, okay, it's higher than what it was, but it's still a discount to that net asset value, that magic number. And then there was a go shop period and no other bidder seemed to emerge. Did I capture?
Yeah, I think you got most of it. Yeah.
Okay, so first let's step back. Talk to me about why you stepped in. Why was it InterRent? Because I imagine you looked at a bunch of names.
So we run a long short portfolio. Our view towards the REIT sector is that we're trying to find those misunderstood, catalyst-driven names that are going to be subject to merger and acquisition, or they're going to be able to, close that net asset value gap on their own. InterRent is a company that I've known since my time at Century. There was a previous management team before Mike McGinn came in to step in, and I've got a long history with Mike. I provided a $15 million investment at Century at $3 a share. In around 2010, we made that investment. I believe it was 2009, 2010, for Mike to really transform InterRent. And they did that over the last 10 or 15 years. So I knew the company very well, know the assets well, know the structure very well. What we saw over the last year or so, and we've been shareholders of the company for a very long time, what we saw over the last year or so was a real opportunity where we thought the market really misunderstood what was going on with the company. It was trading at a material discount to NAV. We thought the assets were performing well, the balance sheet was strong, but there were things that they could improve. And that's why we sort of got involved. I wouldn't say we agitated to sell the company. We got involved to basically drive change so that it could become a better business. And then it resulted finally in Mike and GIC deciding that the best course of action would be to make a bid for the company.
But at $13.55, I imagine it's higher than whatever your purchase price was to get into the stock. But even a few years ago, it was trading well above that. It hit as high as $18. Probably shareholders are wondering, why didn't you push harder?
Yeah. It's a fair question, and we didn't love the way the process ended. By providing the executive chair exclusive opportunity and then having a break fee put in and a go shop period, the go shop period was great, but in terms of timeline, but the break fee and the price that they put in really put a wrench in other bidders coming in.
So you don't think that there wasn't another bidder because there wasn't interest? You think the way it was structured, because a break fee means that you're going to have to pay that if you're trying to break up this deal.
Right. And I think that we would have liked a process where all the bidders were brought in right off the bat. The highest bid was put in place, and that would have resulted in the higher price.
Can you do anything about that now?
Now the time has sort of passed, right, in terms of the current period for the go shop. But shareholders still have to vote on this transaction. And so while we're not going to comment exactly how we're going to vote on this, and I don't think you would expect that we would.
Did you read that? That's the next question.
I think shareholders are going to have the opportunity to decide whether or not the price makes sense for them today. And I think you made a really good point about the pricing relative to where it was and net asset value. Generally, this price was below their IFRS, which is your accounting NAV, and what analysts on the street had in NAV. But what it did was it cleared the market because NAV is a moving target. And I think one of the reasons we really believe M&A will start to pick up in the REIT space is because board and management teams were afraid to do anything below their reported NAV. But here we have a transaction that may kickstart more transactions to find what real NAV is. I
think a shareholder would be hesitant to vote this down because it feels like no other bidder emerged and nobody was really interested. And from the reports that I read, I think it caused a little bit of concern. Like everybody thinks M&A is going to be the savior to this sector. And we'll talk about, other issues where that has come into play. This deal kind of, I think, threw a little bit of a wrench into that idea that there are all this capital sitting on the sidelines waiting to bid up these names.
Yeah, I think I wouldn't fully agree with that. I'd say there is a fair bit of capital on the sidelines willing to come in a proper process and bid for good assets today.
These companies have been, I've interviewed a bunch of executives. You're much closer to them than I am. It's a bad macro environment. It's, rising interest rates, lack of immigration, all these things that were working for them are no longer working for them. And they're just kind of waiting for a better environment. And this deal might argue that maybe so too are the buyers. How do you think about kind of the macro being that's the only problem that these companies are facing?
I think that you've got to separate opportunistic buyers from those that only have capital during good periods of time. I think what GIC has illustrated here is that they're interested in investing in Canadian real estate on top of what they already have. They think they're going to get at a very good price, and they like the assets that they're investing in. Are they worried about the macro environment? I mean, we'd have to bring them in to figure that out. But I think that good prices come with uncertainty, and expensive prices come with certainty. So I think that from a buyer's perspective today, we believe there's a pretty deep pool of capital that's looking at other names in the REIT space right now that would be interested in buying high quality real estate assets.
And I promise we'll talk about them. If InterRent goes private here and there's a fundraising opportunity in the private markets, would you participate in that because you do see more upside?
From a private market perspective, I mean, the only way that we sort of raise private capital are in funds that we do ourselves. We're not a passive investor.
So you wouldn't go joint in.
Right. Yeah.
Okay.
We would do our own. And just to sort of clarify the whole Arch and Anson and setup is that Arch is sort of the real estate arm that partnered with Anson and public market opportunities. So the Arch Anson team would lead these types of public market opportunities to look at something like InterRent or anything else that we're investing in real estate.
Do you foresee Arch/Anson being able to go into other companies the way that you did here, take up a big position and make your opinions known? Was this just the beginning of what we could see out of you?
I'd say that it's something that we're always looking at, but it's not our core strategy. Our core strategy is, again, that long-short REIT strategy where we're looking for catalyst-driven names. We're looking for secular compounders. But I would say the platform that we have at Anson and Arch, being able to look at both private and public market opportunities, the amount of capital that we have, when we see opportunities that we've done a lot of work on, where we feel confident that we could make change that will make the business better, we won't be afraid to build a big position, work with our team, and try to affect that change. But it's not something that we wake up in the morning saying, let's find that next activist opportunity. It sort of comes over time.
All right. That feels like a yes. I'm going to take it as a yes. All right. I think we should get into some of these stocks, but we're going to talk about most of them, I think, from the long side. You mentioned that you do short. I don't know how nimble you are in that position. Like, what is your long short book? Like, what's the percentage long versus percentage short? And, if you want to talk about some of your shorts, that'd be great. What is the characteristic of things that you are shorting right now?
So shorts are very tough to come by in real estate generally. So what we aim to do in our fund is become aggressive when we see really good opportunities, and our exposure will go close to say 100%. And that sort of means we're 100% exposed to the market in terms of longs. But when we're more cautious, we will bring that down to say 60 or 70%. So still pretty long, but more defensive. And a lot of times that will be done by ETFs or other types of macro instruments that help us just hedge our portfolio.
So not singling out single stocks.
We will do single stocks. I don't have any for you today because we see a lot of opportunities out there, and most of what we would have been short has washed out. And so there have been opportunities in the past, mostly where we find over-levered companies that we think are going to do a distribution cut, or companies that are just much weaker than the long that we have in the same subsector.
Okay, now let's get into the mailbag and talk about some of these stocks. Okay, so InterRent is the best performing REIT so far in 2025. We know that. We know the reason why. You're a big part of the reason why. But the second best performing one is H&R REIT. And so the theme to this part of the mailbag will be M&A and names that have come up that are potential targets. H&R REIT, they're exploring options. Blackstone reportedly very interested in buying the company. So there's a process already underway. There's big players, to your point, deep pool of capital. How do you see this playing out with H&R REIT?
H&R, again, is a name that I've known for quite some time, and it's evolved greatly. For your listeners, this is a diversified REIT, so they own apartment, industrial, retail, and office assets. And that's part of the reason they're trading at a discount. They also are in the US and in Canada. So right now, what we've seen is they've become a cleaner company. They're more focused on apartments. They've spun off a lot of their retail. And I think institutional capital is more interested in it. The other reason they're more interested is because a few years ago, Tom Hofstetter had a external management contract, and that got internalized. So there's no real barrier to selling the company today. But diversified REITs don't usually have a deep bidding pool of one buyer. You usually have to get a collection of buyers, somebody who wants the office, somebody who wants the retail. So what's happened over the last little bit is we've obviously seen the press releases that H&R has received interest, and they've started a committee, and that committee is now exploring options to maximize value. Our view as shareholders is that's what they should be doing. We want to make sure that process is run well. But I think where we want to make sure that we're clear from a public market perspective is we'd really love the opportunity to vote on a deal rather than this decision being made sort of at the board or strategic committee level.
So here too, there's an activist in K2, which is saying kind of the same thing. I want to know the terms of viable bids. Are you aligned with them?
Well, I think we think for ourselves. I'll make that very clear. But where we're aligned, where we're aligning ourselves is we'd like to trust that the strategic committee is running the process properly, and we are very clear publicly that we'd like to be able to vote on any kind of transaction that's brought to the table.
Because it's unlikely, in your view, that they get a bid for the whole company. So maybe they sell off. What do you think is the most realistic area that they might sell first?
I think the likelihood is that they do get a bid for the whole company.
You do, okay.
Yes, but the likelihood that there's a deep pool of multiple buyers waiting in the wings to come together, agree on the pricing for each individual asset class, and make a bid together, I think that's unlikely. So there could be a couple of people, for sure. They should explore and maximize value. But the ability to see that going very deep is rare, in my opinion.
So, say it as Blackstone, you think that's what they're going to ultimately do? They can buy the company, and then they'll be the ones to do the work of maybe splitting up the company and selling to different bidders.
I don't want to speculate. It may be that they do that. It may be that they find the partners before, and they all agree on what they'd be willing to pay for each part of the company.
Do you have a hopes and dream price for what this gets taken out for? It's trading at around $12.
Yeah, I think it's one of those things that it's probably going to look very similar to how the InterRent transaction went down. That's probably where I leave it.
Just a little bit of a discount to their net asset value.
I think it's again, bidders coming into this macro environment. That's probably the most likely scenario.
Do you know the NAV offhand of H&R REIT?
Yeah, I mean, it depends where. This is another situation where you've got analyst NAVs that are probably in that kind of
$12.
I mean, they're $12. I think it's probably closer to $14, $15, and then their IFRS NAV is in the high teens, I believe. So it's probably, that's why I think it's very similar to the InterRent situation.
First Capital is another REIT actually reported and is trading a little bit higher. It saw good income growth in its most recent quarter, good renewals in some of its assets, and has picked up a little bit. Is First Capital one that you like?
First Capital is a company we like. I think it's probably the best retail portfolio in Canada. They just reported actually, and you see the lack of available space has allowed them to increase rents as well, and that's driving right into their free cash flow. We think the portfolio would be very attractive probably to a institutional buyer, and it's clean, right? Everybody will know what you're getting in terms of the bidding pool, and they've probably got a good amount of development land that would be attractive to somebody who has a longer term view towards developing retail assets.
Is it in play?
I mean, officially,
Not officially, no. Yeah.
Officially, no. I'd say it's one of those names that is on the list of people that believe with attractive asset class like this and assets that have been built over time that could be an M&A candidate.
My memory is fuzzy, but I remember a few years ago. This is the one, is it Dory Siegel?
Dory used to be involved with Gazit.
Yes. And there was an activist pushing for change that kind of went away. Do you see similar sort of ripe, ripe conditions for something like that to happen again?
I think so. That activist campaign did step away. I think there's some board members that may have still been involved from our peers that are still with First Capital. I think that having seen that activist campaign kind of play itself through, it seems unlikely to me that there's going to be a renewed interest in that. That being said, I'd say that if the company cannot continue to drive rents, free cash flow, manage its balance sheet effectively, and get closer to where its NAV should be, that always remains a possibility because it's got such a high quality portfolio.
Is the pool of capital interested in shopping centers like as deep as maybe multifamily?
I think it's a great question, Amber. I think we're out there on our private side looking at both asset classes, and the shopping center, I call it retail more, high quality retail has really perked up over the last 12 months. And apartments have stabilized, I'd say, from falling from grace, so to speak, in 2021.
Yeah.
But it's still a very strong asset class.
One that I hear rumblings about is about Minto. It's a smaller REIT. It's an apartment REIT. And there's a lot of family control that seems like it would preclude a sale. We got a question about Minto. It was one of the top picks from a former guest on this show, John Ewing at Ewing Morris, kind of hinting that, maybe it's not as out of the M&A game as one might think. How do you think about that?
Minto's a company we know very well as well. And, it's a comp to InterRent, Cap REIT, Boardwalk, Killam, all the apartment REITs out there. But the biggest difference is that they're very, very focused on a couple of markets, Ottawa, Toronto. They've got higher quality kind of rentals in their portfolio. And as you mentioned, there's this family controlling interest. They're trading at a material discount to NAV right now. Depending on which numbers you're using, it can be anywhere from 25 to 40%. And with a high quality portfolio like that, it's trading at that level of a discount. The family's really got to ask itself, do we want to stay public like this, not be able to grow for how long are we going to do this for? But with a 40% shareholder, obviously they do control the situation. So the question from our perspective would be... And
it's not just one shareholder. My understanding is it's a big family.
It's a sort of family unit. Yeah. It's a little opaque and we're not really sure exactly what that looks like. But I think the control is still there. So that growth profile and the ability to stay public versus private, they'd probably evaluating that right now. If I was in their seat, that's what I'd be doing. Can we find a partner? Can we find a way to grow? Or are we going to stay public and at a discount for a very, very long period of time and just wait for it to come back?
Now, is that enough of a reason to buy the stock?
It's a great question. I think from our perspective, really getting an understanding of what management's plan is for the assets themselves and putting aside the things we can't control would be the most important. So we still like it. We think this discount is large enough that it makes a lot of sense to own the stock here relative to its growth profile and what we think is going to happen in terms of fund flows coming back to the sector. Because you should know the REITs from a fund flow perspective have been completely ignored in favor of tech and everything else that's you talk about on your show fairly often. So once that sort of comes back, we think names like Minto and others will get recognized.
Do you think rate cuts are a catalyst for those fund flows? I mean, we just had a Bank of Canada rate decision. Again, no change to interest rates, and they've already lowered somewhat. The Fed is unlikely to cut interest rates and will be brought there kicking and screaming maybe once this year. Is that the catalyst everyone's waiting for, or what is it?
I think it's part of the catalyst. I don't like to say that REITs are pure interest rate sensitive vehicles. They grow, they do transactions, there's M&A, they're not bonds. But at the same time, fund flows, you can't fight against them. And if you look at the fund flow charts that we sort of put in our presentation materials, the REITs have been at the bottom of the list for some time. So we think that a few things need to happen. Interest rates need to coincide with low, but not negative economic growth. And the other sectors' growth bloom needs to come off. So it's a little bit of what I was saying before. M&A, macro, all coming into play will start to pick up that fund flow. The other key thing is if you have a GIC that you say did at 5%, right, at the height of the Bank of Canada kind of rate rises, that's going to have to be renewed. So you sit down with your advisor and say, okay, are we going to put it in at 3.5 now? From a tax efficient basis, does that make sense? Or let's put it into some income paying vehicles that are going to give you higher income and are discounted.
Let's close out this part of the mailbag by asking about Mainstreet Equity. I don't think anybody thinks this is a takeout candidate. Bob Dylan's going to work till he's like 95. And he'll actually be one of our CEOs that we interview this summer. But Mainstreet Equity, kind of a cult-like stock because it's done so well. It's off in 2025. Is that an opportunity?
I think, Bob's going to be an interesting guy to interview for sure. I've known him for some time. And it was very interesting. I met Bob really early in my career, and he had a very, very different vision for his REIT than any of the other REITs we were investing in. No capital raises, reinvesting into the REIT for acquisitions and capital, and it's worked really well. A lot of people say this is probably like, if you look back on it, it would have been the only real estate company you need to own because of what he's been able to do.
Just to underline, he just started paying a dividend, but like for 20, 25 years, no dividend, reinvesting everything, only buying in Western Canada, old buildings, 40 years, 50 years old, and fixing them up.
Yeah, we should have got into that. But yes, they're in the residential space.
Yes.
But yes, he buys buildings, fixes them up, refinances them and moves on. And that's where the capital comes from, that value creation. I'd say for any investor that's looking towards investing with one of the best CEOs out there, who's been one of the greatest compounders of real estate value creation in our time, any pullback in the stock probably makes sense to add some. But it is illiquid, and you've got to hold it for some period of time.
Okay, let's take a quick break, and we're going to talk about some distressed areas of the market and see if there's an opportunity. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, everybody wants to know about office. When is it going to be time to get back into office? And we've got questions on Dream Office and Allied Properties, which also reported, and the stock's not getting a really warm reception on the back of its earnings. But everybody seems to be going back to the office full time. So why isn't that a catalyst for the sector? Why shouldn't I go all in on office REITs?
Yeah, I think if that's your only metric, it'd be very, very tough investment to make. I think office, I hate to spoil the answer, but it's not going to be something that sorts itself out in a quarter or two. We have seen really, really strong inflection points in the US and Canada in some of the key markets in terms of return to office, as you're saying. But they're still going to take a lot of time to get back to sort of where we were. There was a lot of supply coming online during COVID. That still needs to be absorbed. You've got a lot of tenants that were moving towards Class A space and shunning sort of Class B and C space. And that is an issue for some of the REITs in Canada and the US. So we're looking at, I hate to use this term, but green shoots like in the office space, and any sort of unique situations where there could be a privatization opportunity, or management sees an ability to sell off a portion of the portfolio. Allied Properties sold their data centers. They're still trying to push, and they have very, very aggressive occupancy targets that we're not sure that they're going to be able to meet, but they're doing the best they can in a very difficult operating environment.
I spoke to one analyst, Matt Kornack at National Bank, and he said, yes, everyone's returning to office. There's still, I think he said 17 million square feet available. Like, that sounds like a lot.
Yeah, it is a lot, but it's all in the context of the actual market that you're in. So the key kind of metrics that we would look at are just your pure vacancy and then your sublet space. And some of that space is starting to get absorbed. So you're peaking out in terms of those numbers and coming back the other way. And you have seen a trend on the corporate side of people requiring people to come back to the workers to come back to the office, and more of a push towards having to expand space because they don't have enough space. I just read an article recently about people trying to fight to come into the office early to make sure that they have a desk, or they're working out in the hallway. So those are the things that I think that are really going to push the office sector. And then obviously with every sector, when you have lack of supply or the supply that you have is absorbed, that really, really helps.
I want to talk about, we're going to close out the mailbag with an IPO in Toronto. Two things we don't say very often. Yeah. This one was called Go Residential. It was unique for a number of reasons. It, first of all, is the largest IPO that we've done this year in Canada, raising $400 million US. But it was an American. It's American company, and it holds US assets. What did you think when you saw that IPO? Did you buy into it?
There's certainly some positives and maybe a couple of areas of thought that come from this transaction. I think if you look back in 2021, 2022, 23 even, the likelihood of an IPO just seemed absolutely crazy. And the ability... Let
alone a REIT IPO.
A REIT IPO, yeah. And a REIT IPO especially, actually. So if you look at the IPO getting completed, investors getting behind it, that's a positive signal. How it's traded since, probably not so great.
It's come off, yeah.
It's come off, but a lot of that has to do with sort of what the trading environment you're heading into and not necessarily reflective of the company fundamentals. But on the other side, they had to price the assets at a material discount to NAV to get this deal done. It wasn't as if they're getting full price for these assets.
And I imagine they tried in the private markets first then.
I mean, our understanding is that was not a possibility, and that's why they sort of moved to the public markets. And so there's pros and cons to take away from this. It's something that we think will hopefully kickstart some more activity and idea generation, but you'd like to see these IPOs do well, right? Because it's hard for investors, especially outside of the real estate dedicated investors, to get involved in the space when the momentum starts to slow with deals that don't do that well.
All right. Good perspective on that IPO. We're going to get into your pro picks now. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, your pro picks are interesting. And in some instances, I would say they're not household names. One is if you're familiar with the REIT space, but let's start with the more under the radar and maybe even the smallest one. Your first pick is BSR REIT, U.S. Sunbelt exposure, but trades up here on the TSX.
Yeah, so it's another one of those names that has U.S. real estate exposure, but trades in Canada, so similar to the IPO we were just talking about. And they're focused on sort of Sunbelt markets, mostly Texas. They have been listed for quite some time, and they're starting to see an inflection in their property fundamentals. So you're seeing their operating fundamentals, occupancy, and cash flow start to grow. But there's a couple of key things that have happened from a valuation perspective that's important. First, they had a complicated structure where there were some Class B shares that could have stopped any transaction from taking place from an M&A perspective. Those have been eliminated. As well, you also saw Avalon Bay, which is a big US REIT, buy 10 of their assets at around IFRS NAV. And they're trading at a 20 to 25% discount to NAV. So this is one of those opportunities. You've got a high quality portfolio, inflection in their operating fundamentals, clean structure, and a transaction that has clearly shown value. This is a name that we like and that we own.
And the market may be not paying attention to any of that.
We don't think they are, right? They're trading at that discount. And it's sort of the same thing that you've seen play out, is that until some sort of catalyst plays out, the public markets will trade these things at a discount for longer than they should.
So trades at around $13 per share. The highest price target is $16.50. Is that around where you are, or you think the value's even higher?
No, I think that's fair. Yeah.
The second pick, the second two are both in kind of the senior and retirement space. And that feels like easy. That's that's kind of like, of course, that's kind of like the only part of the market that is held up. Your first one is Chartwell Retirement Residence. And I shouldn't say that because they really had to come back after the pandemic.
They did. And I'll differentiate them to you for
Please
you.
do. Yeah, let's start with Chartwell.
One of them's trading at a premium to NAV and one of them at a large discount. And so Chartwell's trading at a large premium to NAV. It's a name, again, that's been a household name in the Canadian REIT space for some time, but they've done a really good job of cleaning up their portfolio. So they used to have some exposure to long-term care. Now they're purely private pay, independent living, and assisted living. Vlad, the CEO, has spearheaded that transaction, that kind of transformation. And this kind of has coincided with supply falling off a cliff in retirement and demographics continuing to go the right way for them. That has resulted in occupancy rising, which we still think it has a way to go, and as well as very, very strong cash flow growth. We're expecting 15% out of the name for 2026. That compares very favorably with its peers and probably why it's trading at a slight premium.
Is it only slight? Because I was going to ask, what's the upside?
Well, I mean, the upside could be very dramatic. It's an M&A candidate, and if you look at its U.S. peers, some of its closest U.S. peers are trading at 100% premium to NAV.
Wow.
Yeah. So if you look at names like Welltower in the U.S., they're trading at large premiums to NAV. So that actually doesn't look that bad for a 15% cash flow grower going into the future.
So you think that somebody could come in and scoop up Chartwell?
It's a widely held shareholder base. The valuation is attractive. The assets are very well managed and attractive as well. It certainly would be at the top of our list in terms of M&A candidates for people looking to grow in retirement. At
that kind of premium?
I think it's if you have a strong growth profile, you're willing to pay a premium.
Is there a U.S. buyer, you think, or it could be a Canadian one too?
I think there could be pension plans. There could be a U.S. REIT. That's why we like the name. We think there's multiple avenues towards driving shareholder growth, and only one of them is M&A.
Brookdale is your third pick. Again, seniors, but trades in the U.S. What is the opportunity? This one you say is trading at a discount, even though it's perked up a little bit in 2025.
It has perked up. So I will tell viewers, this is more of sort of a levered way to play seniors housing. This stock, conservatively could be up $2 to $3 from where it is today. If you get a little bit more aggressive and their occupancy really starts to pick up, we start seeing a stock that could be, in the mid-teens. So we like it because we believe that the operating fundamentals have really inflected. They've got a high quality portfolio all across the US, and they're seeing the same trends that you're seeing in Canada. Demographic tailwinds, very, very little supply coming online, and that's all flowing into Brookdale. And there has been activism around it that's kind of dissipated.
Because Brookdale won against the activist.
Brookdale won, yes, but even in periods of times where activists sort of don't necessarily win, I think the management team and the board is still on notice that they've got to create value. You can't continue to trade at a perpetual discount to NAV forever. And if you're in an asset class where your peers are doing much better than you are, then you've got to really step up. And we think Brookdale will, and we own it.
So all three of these, BSR, Chartwell, and Brookdale, they have an M&A twist. And when you just think, you think, I guess that aligns with your thesis that like it's on. And we're seeing it in every single industry. M&A is at a record, so we're going to hit new records in 2025 for the amount of deal activity. And it sounds like you're saying REITs are going to be a big part of that.
I think that they will be. And part of it is our investment strategy, and part of it is sort of we think it's the right time. And with macro stabilizing, again, while there weren't interest rate drops today, we think the fact that inflation has come down and interest rates are stabilizing and valuations are stabilizing in real estate, that's what's going to push M&A forward. And you're going to start to see buyers become more confident, and that's going to play out, not necessarily next month, but over the next 2 years.
Michael, fascinating conversation. Thank you so much for joining me.
Thanks for having me, Amber.
That's Michael Missaghie joining me of Arch Corp. Make sure you tune in to our next episode. It is the beginning of our CEO summer series, and our first CEO on deck is Kevin Strain. He's the CEO of Sun Life. You won't want to miss that episode. It comes out next Tuesday, and we'll catch you then.